This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
I want to move on to our post-game chart deck. Listeners, you'll find the download link in your Research Roundup email. Now, if you don't have a Research Roundup email, it means you're not registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, click the red button above Victor's picture that says Looking for the Downloads. Patrick, the title slide says Equities, Oil, Gold, and More. Let's hit page 2. We got Equities, S&P Futures, continuous chart. What's going on here?
Well, I mean, we obviously have a market that is pulling back to some key averages. You highlighted it in the market wrap that that 100-day moving average has been tested in such a critical level. So obviously, this is a really important moment in the markets, and it's going to be really interesting to see whether or not this spurs the buy on dip reaction that often comes here, right?
Exactly. And, if you look at this chart, you can see every time the S&P has closed below its 100-day moving average, that was the bottom. It was the buy the dip moment, and everything was all uphill from there. Is that going to work this time, or has the game actually changed? And the ways that the game might have changed would be, number one, I think the pandemic is ending and switching to its endemic phase. Omicron will be with us forever, probably. But we're going to switch out of pandemic mode into endemic mode. That's going to open up the global economy. I'm not sure what it means for accommodation and support from central banks for markets, but that's going to be one of the factors. The other factor is the Fed really has pretty much boxed themselves into a corner around saying that they're going to taper their asset purchases. They're going to trim back their balance sheet. And now they've got far less excuses to do otherwise because, hey, if you still had a pandemic on and the market was crashing because of the next taper tantrum, the Fed would have an excuse to come to the rescue. They're not going to have as many excuses if I'm right and the pandemic really is ending in favor of the endemic phase. So is this the buy the dip moment, or is what we're looking at in today's up candle just the dead cat bounce before the bottom falls out of this market? I have no idea, Patrick. It's going to be really interesting to find out. My gut says bottom falls out of the market, but I'm jaded by the number of times I've been wrong with that call in the last 10 years.
Well, you know what, Eric, actually, I do see some red flags. For instance, you did point out the 100-day and the fact that we're there. But let's go back to the fact that November and December had pretty much two tests of the 100-day moving average. And typically market corrections, of those 5% varieties, typically end up having about a 1-month consolidation. And often the buy on dip is spurred from there. So when we had that December Christmas rally that pressed the market to a fresh new 52-week high at the time, that should have opened the window to a rally that typically would last 30 to 60 days and have a solid bullish impulse. But instead, what we saw was that entire breakout attempt being completely given back, and we're trading at the same levels we were then. This is a very heavy and toppy market, and the fact that we never followed through on that very clear bullish signal that should have seen that follow through, it didn't happen. And so those are, to me, red flags of at least topping formations that makes the market more vulnerable. Obviously, there's no guarantees of a massive downdraft, but it's certainly a heightened risk at this moment. So when we go to page 3, another thing that kind of caught my eye about this buy on dip is looking at where it is relative to the VIX. Now, typically, whenever the VIX jumps to the 30-plus level on the upside is when we typically see some really kind of fear in the markets as options traders are grabbing options and paying up premium to participate in the volatility, and usually see that VIX spiking. What's interesting is the last corrections, whether you look at the September drop or whether you look at that November drop in the markets, each one of them spurred a VIX that jumped toward the 30 level. And more importantly, they were the similar style market corrections of those kind of 200 plus market drop kind of moves. So here we have this 2-week, 300 point drop in the S&P, and the VIX is still at at the 22, 23, 24 level, and no one seems to be panicking. And so the question has there been enough fear? Has there been enough panic selling in order to put in that swing low? And I'm asking it. I'm not sure I want to make a bold call, but that's just another sign that maybe the oversold conditions that typically have associated with previous buy on dips may not be here this time around at this 100-day moving average.
Patrick, let's get to where the rubber meets the road in terms of what you would recommend to listeners. How do you decide? We both agree that it's uncertain right now. What's the signal? Are you looking for an acceleration of downside momentum below the 100-day to tell you, okay, it's game on, this is ugly? Or is it something else? What's the signal that tells us which way this thing is going?
I think the next 3 days will tell us everything you want, because when you come to a critical level where buy on dip traders should be buying the dip, well, then it's a simple thing. Did they show up and buy the dip? If we go 2-3 days and every rally is failing and there's just no sign of the buyers in sight, that becomes a very big warning that simply there isn't the buy interest to reverse the market higher. And the more that people realize that that momentum is shifted and that the buyers aren't coming in, liquidity's not there, the more likely it is that we can reach that point where people just start selling aggressively and hitting that bid. And so I think it won't take more than 2-3 good trading sessions to get a good feel on what's happening. What I wanted to highlight as well is it's not just the S&P that's at some critical levels. So let's go to Nasdaq on page 4. And so the Nasdaq failed at its 50-day moving average last week. And here we are at the 200-day moving average, a very traditional and very well-tracked moving average on indices with the 200-day. And we're more or less trading at a level where, again, we would typically see the buy on dip traders show up. And so this is in the same theme as the S&P. Will we see that this spurs a buy sequence where we kind of wipe out the last round of selling and get the Nasdaq, let's say, back toward 16,000? These are some very important things to watch going into next week. The other really important one to kind of highlight is on page 5, the Russell. The Russell spent almost the entire 2021 year trading sideways. And there was a major support line just around 2100, where every time the Russell traded down there, it acted like a key support. Yesterday, we decisively broke that key support line. Now, one day doesn't make a new trend, and if the Russell is able to quickly reverse and get back above that level, then it could have just been a fake out, the kind of like gunning the stops kind of move. But this is such an important moment. Like the Russell's already over the edge of the cliff, and the question is that just a warning sign that there's more weakness to come in the other indices? Anyway, Eric, let's get to page 6. We got to talk crude. What's interesting is that this move on the upside of crude oil has just been one serious rip. I mean, we went from $65 to $85 in a month, $20 move on the upside. I personally think that it's a little too much too fast, and I did a lot of profit taking for on my energy stock positions. But what's your take? I mean, obviously, I'm still bullish oil in the bigger picture, but is this a little overdone?
Well, I think it's a lot overdone, but I'm not convinced that it's going to stop being a lot overdone. First of all, what's with this huge rip? It was really pretty easy to see. We talked about this even as the down was still happening, as the price was collapsing. We were telling you on MacroVoices, this is all a stupid Omicron panic because people are not paying attention and understanding that Omicron is not the threat that they think it is. And as I said before the new year, I'm super bullish crude into the new year because I think that's all going to be fully retraced as we recognize that Omicron was actually a blessing in disguise and has the potential to end the pandemic. A view at the time that I was ridiculed for, which now has become commonplace and people are ridiculing me for thinking that it's a different than consensus idea. I didn't actually notice when the consensus caught up. It's been obvious to the smart people for more than a month now that Omicron was likely to end the pandemic. Probably approaching 2 months now. Before it was named Omicron, that was clear. What's happening now is we're seeing that retrace, but on top of that, the industry is very concerned about running out of oil in Cushing, Oklahoma, in order to settle that March contract, which actually comes into expiry at the middle to end of February. I think that's the reason we went right through. Normally, you'd expect as we hit that double top, at the 84, 85 level, you'd expect at least a pullback before breaking through to a new high. It seems like the market sliced straight through it. And I think the reason there is because of the fear of a physical supply shortage in Cushing, Oklahoma. I've got a chart coming up a little bit later on that'll show us that in terms of the action and the time spreads there. What concerns me about this is I do think it's that fear about Cushing running out of oil that has propelled us so quickly right through those previous levels. That means if they figure out a solution to this, if they get enough oil so that they're not concerned about Cushing running out of oil anymore because they've solved the problem, I think that is going to be time for a significant correction. Could be $5 or $10 to the downside because, hey, with this big of a move up, a $5 or $10 correction to the downside doesn't even invalidate the bull trend. So there's lots of room for a big correction. I don't think it happens until we resolve this question of what's going on with Cushing inventory.
Right. I did want to highlight just some of what's going on in the energy stock space, because, certainly the point you're making makes a whole lot of sense, and that's certainly a macro driver that is on the short term going to drive the oil trend. But these energy stocks have really taken love to this, and this has been one of the few sectors that has just been so strong throughout the month of January as energy stocks rip higher. What's interesting is while these energy stocks are getting there, on page 8, I have the S&P energy sector bullish percentage index, which is gauging, it's a very good gauge of the overall overbought or oversold conditions in there. And every time we've seen this bullish percentage index approach 100%, it has also spurred some sort of a correction. So it'll be really interesting how the market settles this. You're absolutely right. On the short term, we might go higher because there's a legitimate squeeze getting underway. But is this now starting to get fully priced in? And really, is it like still the 7th inning? Is there 2 more innings to be played? Or are we already in the 8th, 9th inning of these moves? And I've already started taking some off the table, but certainly there's room for this to keep going. One of the interesting things on page 9, though, we have is your time spread chart. And this has been a story that you've been tweeting about. What's going on in this chart? How do we read this?
Patrick, time spreads are a fascinating subject, and I'll be the first to acknowledge that there's more religion than science to them, but I'll tell you how I interpret this data. If you look on page 9 on the left side of the chart, you see a very familiar and welcome pattern to crude oil traders, which is the prompt time spread. That's the difference in price between the February contract and the March contract, what traders call the GH spread. And the reason for G and H is those are the letters. G means February and H means March in futures trader speak. What you see on the left side of the chart is the nearest time spread. The difference between February and March price is the lowest time spread on the chart. And furthermore, as you see on the 13th in the afternoon, right around noon, it starts diverging much lower. So the difference in the vertical space between the yellow line, which is the next one, that's March to April, and the red line is both large and getting larger. That's very typically what we see going right into options expiration, which was on Friday the 14th. But what you see on Friday the 14th is right around 9 a.m., which is when the U.S. market opens, all of a sudden, that red time spread, that's the difference between the February and March contracts, all of a sudden, that starts rocketing in the opposite direction of what you normally see on options expiration day. Normally, that would be collapsing to the downside. It's going straight up to the point where a couple days after OPEX, yesterday on the 19th, that spread went rocketing straight up through and became at the very top of the stack. It hit $1.30 last night. Wow, super high. What's going on there is the market is putting an extremely high premium on February oil over March oil because they're afraid of running out of March oil. Now, this GH time spread that you see at $1.12 here, after this snapshot was taken, that thing went all the way down to the mid-70s and then back up again into the high 80s, which is where it is right now. So what it's telling us with these elevated spreads is that the industry is scared of running out of oil in Cushing in February when it's time to settle the March contract. The red spread, the GH spread, was the best proxy for that. Going forward, the HJ spread, the yellow one, is going to be the proxy for that risk or fear factor. And as you can see, it's already breaking away from the pack of other spreads and moving higher. Does that continue? Well, if you could see this chart going a little bit later into the afternoon, both GH and HJ took a nosedive, but then they recovered. So the market is trying to figure out, do we really have a Cushing running out of oil in February risk or not? If we do, what's the solution? Well, high prices. If there is a problem, the way it will be resolved is that HJ spread, the yellow spread, will blow up to the upside, and that creates the financial incentive for more people to deliver more oil into the market sooner rather than later. So that's what's going on with the spreads here, and I think that that's also because there's that tightness and that fear of running out of oil, that it's probably what's driving this very, very aggressive upside move in the flat price. If you see the yellow and purple spreads start to collapse to where they become not only the bottom of the stack here, but they start going down to 70, 60, 50 cents, getting down below 50 cents, that means fear is coming out of the market, and it portends that probably the flat price is about to enter a big correction as well.
Well, thanks for the explanation, Eric. That makes a lot more sense now. Anyway, what I wanted to just finish up on the chart deck, I wanted to touch on gold and some bonds. And so we were talking about it during the market wrap at the beginning, that little breakout in gold. And what's interesting is the breakout did happen on gold. It is much stronger on silver. And when you look at gold miners on page 11, they also had a breakout. One thing that I always say at Big Picture Trading is one day does not make a new trend. And you really did highlight the key, is that every time we've seen gold and silver do these breakouts, often they were faded. And I think that's the single biggest thing to watch here in the coming week is, will the gold bulls now gain some traction and start to follow through on this breakout, or is it completely faded and we back into the trade ranges? It's got to be the thing to watch next week. What is, though, interesting about the gold miners is I also figured out, look up that bullish percentage index on the gold miners the way we did on the energy stocks. And what's interesting is that the gold miner percentage index is in the almost exact opposite situation as the energy stocks, which is it was quite oversold, definitely at the bottom end of trade ranges where typically we have seen bottoms over the last 5 years. It'll be really interesting to see whether this turns, because from a sentiment and from a bullish percentage index basis, this looks like the bottom end of that range, and it'll be interesting to see whether a new opportunity emerges there.
I agree, Patrick. I don't know if this is the turning point or if it's still yet to come, but when we see a clear turning point in the metal, boy, the stocks have plenty of room to catch up because the miners are very depressed, and there's plenty of room for them to make a big move to the upside. The reason they're depressed, well, we've been talking about why the fundamentals were in place for a big gold market for like 5 years now, and it hasn't quite materialized yet. If we see that start to materialize and we get a sustained move in the price of gold itself above 1880 and it's accelerating to the upside from there, I think you see a huge turnaround of the mining stocks very, very quickly. But let's move on to the 10-year yield on page 13. Boy, hitting a fresh new high there in yield, 1.90 briefly on the 10-year. Boy, what does this mean?
Well, listen, I just put this as a reference point. To be honest, you already referenced the 10-year during the market wrap. What we generally have seen, and one of the things that I wanted to highlight was, Victor was talking about those credit spreads on corporates, and I actually completely agreed with him. I wanted to highlight them in the chart deck. So the 10-year yield's been pressing higher, but so has been the 2 and the 5-year. And those shorter duration ones do have a very big influence on corporate debt because of the duration matching. And one of the things with this breakout in that 10-year yield on the upside, it's been driving weakness generally in corporates. But what is interesting is that we have not seen any movement in the credit spread. So when we look on page 14 and 15, 14 is the investment grade corporate bond yield credit spreads, and on page 15 is the high yield junk bond credit spreads. And what's interesting is that we really do not see risk or nervousness yet emergent in this. And just like Victor highlighted, as liquidity tightens, it'll be really interesting to watch these sort of as a canary in the coal mine. When do we start seeing these markets start to get nervous about things and start commanding a premium on these spreads? I think that's certainly going to be one of the more interesting things to watch throughout the rest of the year.
Well, this chart on page 15 absolutely fascinates me, Patrick, because if you look at this chart without really understanding the context of what it means, it sure looks like the normal condition is a spread of about 4%. Something crazy happened in the beginning of 2020. Well, yeah, there was a global pandemic, and it went all the way up to a crazy 11% premium. You know what? It's backwards from that. These are junk bonds. They're called junk bonds for a reason. 10 or 11%, that's a normal spread for junk over Treasury in a normal market. We're coming off of these crazy, crazy lows, and we can only get back to normal for just a brief instant in the middle of a pandemic, and then we went back to crazy lows again. Someday, there's going to be a moment of reckoning where people are going to realize that junk bonds got named junk bonds for a reason, and that they're not worth what people pay for them. And the fact in Europe, I think there's actually still some negative yielding junk bonds.
Yeah.
What are people thinking?
The ECB is buying somewhere. We'll see when the Fed gets into this market anyway. That's it's really interesting. But I do think, though, that Victor's going to be right. Like as these conditions tighten, at some point the liquidity is going to dry up, and these types of markets that need to access the credit will have to start paying up to get it, and it should start reflecting on these spreads. And I think that will be a very good signal that the liquidity draining market tightening conditions are upon us.
And folks, if you enjoy Patrick's chart techs, you can get them every single day of the week with a free trial of Big Picture Trading. Patrick's service information is on pages 16 and 17, or you can find it at bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.